Hello, my name is Dino Hoss, and today we are going to go through non-profit organisation accounts, or club accounts as they're also known. So the first thing to point out is that a non-profit organisation such as a charity or a club like a football club that's run really just for the benefit of the members still has to account for money coming in against money going out. It's just that they, rather than talking about profit or loss, because there are no shareholders or owners, and then we have to talk about surplus or deficits. Surplus just means they've got more money than they've spent, and a deficit would mean that they spent more than they actually had, in which case there would be only one solution to that, and that would be to get the members to pay more money in to cover any debts that the company, or in this case the organisation I should say, would have. So the very first account that we're going to go through is known as a receipts and payments account, and essentially it is the bank account of the non-profit organisation. So any money that comes in on the debit side will be shown as an entry. So the bank, the amount of money they have in the bank in this case, a bank balance, would be on the debit side. Usually the members who are part of a club will pay a subscription. It's like an annual joining fee, which helps to contribute towards paying the costs. So if you were part of a football team, you might pay, say, £1,000 or dollars for the year. That helps to buy footballs, pay for the referees, rent somewhere where you can play the games, etc., etc. So that's subscriptions, we call that. In some circumstances, the club is lucky enough, or the charity is lucky enough to own their own premises, in which case they may rent out part of that premises for the use by other people. So, if, for example, you owned a football field and you were a football club, you could rent it out to other users and charge them a fee, in which case you would be receiving a rent. Sometimes there are things like summer schools where they run football camps and clubs. Perhaps they would rent it off the club for that reason. And then, so that's your debit side, all money coming in. In total, they've got 2360, 11,480, and $1,160 coming in. But they've had to pay, for this particular football club, they've had to pay the groundsman, who is essentially the gardener who keeps the grass looking good, and a state to play football on, $7,270 over the year. They've had to pay other expenses of $2,960. Committee expenses, presumably that's for when you have your meetings, and perhaps you've had a lunch, for example, as part of that meeting, or you've had to go to a hotel. That would be a committee expense. Any printing and stationery you had to do for the club. And so at the end of the year, we can see that we had 15,000 in, but we spent all this money. So at the end, we are left with 3,850, which in this case would be shown as a debit bank balance at the beginning of next year. So a club or a charity would also have to draw up the equivalent of a trading and profit and loss account, or an income statement as it's now called. Except because it is a non-profit organisation, we don't call it a trading and profit and loss account or income statement. We call it an income and expenditure account. And the reason you draw one up is so that the members who are paying a subscription, or the charity that's running on behalf of a good cause, knows that the money isn't being misused. It's being used for the benefit of the charity or the members, in the case of a club. We also talk about, instead of net profit, a surplus of income, which is money coming in over money going out. So as long as the money coming in is greater than the money going out, then you've made the equivalent of a net profit, except we call it a surplus of income over expenditure. If the expenditure is greater than the money coming in, then you would have an excess of expenditure over income, the equivalent of a net loss. And as we covered at the beginning of this video, The receipts and payments account is the exact equivalent of a cash book to a private profit-making firm. We would also draw up a balance sheet in a non-profit organisation. And the balance sheet would look almost identical to the balance sheet of a sole trader or a partnership. The only difference is that the bottom half, which we would usually put as finance by, instead of using finance by in the bottom half of the balance sheet, we use accumulated fund plus liabilities. So the accumulated fund basically is the amount of money that's been not invested, but given to the non-profit organisation, either by people making donations, if it's a charity, or the subscriptions paid. So that means that our accounting equation becomes, instead of assets is equal to capital plus liabilities, our non-profit organisation would have a balance sheet where the assets in the top half are equal to the accumulated fund. So that fund, the money to pay for the non-profit organisation, would either have come from donations if it's a charity, or if it's a club like a football club, it would have come from subscriptions where people subscribe for the year to be able to play that sport or join that particular club. It could be a dancing club, I suppose. All right, plus the liability. So assets equal to accumulated funds from donations plus subscriptions plus the liabilities. So I'm going to run through how to draw up an income and expenditure account and balance sheet for, in this case, Short Road Football Club. So it's an actual club. The first thing to point out is that very often these clubs, they run a bit of a business on the side to create extra profits. Obviously it would be a net profit for the club members. So if you had a football club, you might operate a bar or a restaurant. So at the end of the game, everyone goes into the bar or the restaurant. And it's run as a business, and it's taxable also as a business. But its profits are then ploughed or given back to the company to help to pay for new equipment or to reduce the subscription fees for next year. Okay, so you've effectively got really three types of account that you'll be asked to draw up in an exam situation as an accounts student. The first is going to be of the trading account for that particular restaurant or bar. Then you'll be asked to draw up the income and expenditure account, which is the equivalent of the income statement for the profit and loss account. And then you'll be asked to do the balance sheet. So here we can see the income statement, which is just your normal trading and profit and loss account for, in this case, the bar that's being operated. Very common for sports clubs. People retire after they've played the game to the bar and the restaurant where they'll eat food and have a few drinks. And so the sales for this bar were 168,250. The bar was stocked with drinks and food. And the closing stock figure left you with a cost of goods sold of 104,341. So that's the running of this particular bar at Short Road Football Club has managed to create a gross profit of 63,909. You'd have to pay the people working in the bar. So that's only correct and ethical. In this case, their salaries and wages were 47,500, which leaves you a profit from the bar of 16,409. That could be taxable profits. The government would want a share of that tax because it's part of their club. Although it's a non-profit organisation, has been run as a business, so this income would be taxable. And that profit from the bar is then transferred to, in your income and expenditure account, which if you remember is the equivalent of our trading and profit and loss account. Our income statement for the non-profit organisation is just transferred into the income section. So the profit from the bar is transferred into the income section, as suggested earlier, and the rest of the income and expenditure account, which is the income statement, will contain any other sources of income. So balanced against the expenditure, of course. So if we look at this particular example here, we can see that you've got your profit from the bar is 16,409. The members of the football club paid subscriptions of 35,321. The members also donated $3,600 to help the football club. And they also ran a party where they sold tickets for $6,000. The costs of running the party were $2,000. And of course that meant the profit from the party was $4,000. Now a lot of students put this $2,000 as an expenditure, and of course I understand that you're used to in the trading and profit and loss account putting it as a profit and loss expense, but it's one of those quirks of a club account that we do the calculation for the profit from the party actually in the income section and minus it directly, and then put the result profit or the resulting profits straight into the income section of the income and expenditure account. All the expenditures, you'd have to pay business rates for the water and the sewage and collecting the rubbish. Even though you are a non-profit organisation, you've still got to contribute to the local government. Any insurance would also be added to give you the $19,100 in this case. Telephone costs and postage costs, general expenses, maybe tea, coffee, sugar, that sort of thing. If you had any furniture or sports equipment, you might find that it's depreciated in value. We add all those expenses or expenditure items together, we get 57,780. Now remember, we can't talk about profit because we're not a profit-making company. We are a non-profit organisation. So here, clearly the money going out is less than the money coming in, which is good news for this particular football club because it means you have a surplus of income over expenditure, and by 1,550. Now this money would get added to the accumulated funds in the same way that if you'd made a net profit as a sole trader, you would add that to the opening capital. Except no one owns that 1,550. It's simply just going to go into the money that will help to run the club next year. And the balance sheet of a non-profit organisation, again, looks very similar to a sole trader's balance sheet. It's usually very simple as well. If the company was constructing a balance sheet as a sole trader, you would obviously list its fixed assets. And in the same way as a private sole trader business or partnership would list its fixed assets, the non-profit organisation does the same as well. So, in many cases, the football clubs actually own the football ground and any buildings that go along with it. So here we've got a pretty valuable football club. It's worth 296. Or owns the premises and the football ground worth $296,000. It also owns furniture and fittings that are part of the football club and sports equipment, which are valued at $39,450 and $68,000. So in addition to the club premises value of $296,000, this club is actually quite a fixed asset rich club because it owns fixed assets of $403,450. Current assets will be any amount of food or drinks that you have left in the bar at the end of the year, which is the equivalent of closing stock to a profit organisation like a sole trader or a partnership. Any cash they have in the bank would also be a current asset. Add those two together, the 23,620 and 2,040. You have current assets of 25,660. If you have bought supplies for your bar and you haven't yet paid for them, but they're due within the year, that would be listed as a current liability. Just a creditor would be, again, as a sole trader or a partnership. So we minus that figure from our current assets, and it gives us a working capital of 15,260 and a balancing figure of 418,710. We don't write finance by, we write accumulated fund because no one actually owns this company. And at the beginning of the financial year, the 1st of January 2009, the club had $417,160 dollars worth of funds. So in other words, that's in some ways it could be tied into the ground or the building, but they own $417,160 dollars worth of funds that, again, I suppose if they sold up, that's how much money they would get for everything. And this year they made a surplus of income over expenditure, the equivalent of a net profit of 1,550, which when you add to the opening balance of accumulated fund gives you the balancing figure of 418,710, which clearly balances with the top half of the balance sheets. And finally, one of the other things that gets asked in sort of higher level, I suppose, exams on accounting is how you go about constructing a subscriptions account. Obviously, the members of a club will have to pay subscriptions to be able to use the football club in this case. But some members are better than others, just as some debtors are better than others at paying on time. So, if you have an amount of subscriptions that is still owing, that's known as an accrual. And if you have the good members who pay in advance, that would be seen as a prepayment. So all this information would be given to you in the question, and to draw up the subscriptions account, you'd have to know how much was prepaid at the beginning of the year. So in this case, that was $3,000. How much was still owing accruals at the beginning of the year, which was $2,000. An accrual would be seen as an asset, just like a debtor, because they owe us for something they've already used. So we'd list that on the debit side on the first day of the year. And anyone who's paid us in advance for a service, they still haven't enjoyed the facilities of the football club. That would be seen as us owing them a service, so we would list it on the credit side of our subscriptions account at the beginning of the year. And to finish off this account, we would look at the end of the year, how much money is owed and how much is prepaid. So the prepayments are $8,000, and the amounts that's still owing, people haven't paid us, is $2,769. So those carried down figures would be on the last day of the year, which is the 31st of December. The accrual would be shown on the credit side because it has to be brought down on the debit side, as we discussed earlier, and be shown as an asset because these are effectively debtors for a service they've already used. And the prepayments balance carried down would be on the debit side so that we could bring it down on the credit side, as these guys have paid us for next year's subscriptions. They've still not enjoyed the football club for next year, so we owe them a service, which is why it's listed on the credit side. Any subscriptions paid to us during the year obviously is going to be credited. It goes out of the subscriptions account and into our bank account on the debit side. So we would put that figure of $45,000, which is given to us in the question, on the credit side of our subscriptions account. And the difference, which is here, of 35,321 would be posted to the income and expenditure account. So that's the actual figure that we put into our income and expenditure account under, in this case, income. And that's exactly the same as you would do for the profit and loss account. The difference between any item would be posted either as a revenue received or as an expense to our profit and loss account, except we don't have a profit and loss account. Instead of that, we have an income and expenditure account. So the subscriptions would go into the income section of that particular account.